It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, smartest guy in the room, the governor, the mayor of Beckerville, USA, Mr. Michael Becker. Mike, how are you?
Hey, Paul, doing well. How are you?
We're doing great. Just at the middle of June, in this podcast today is really to kind of figure out, should we take the rest of the summer off, Mike? Does it make sense just to go on vacation?
It's 105 today, I think, is the forecast, or tomorrow. So it'd be good to get the hell out of Texas, that's for sure.
It is. It's definitely always warm during the summer times in Texas. That's, and if you have a good air conditioner at your house or your apartment, no worries. You don't, you are suffering tremendously. But today I really want to get kind of a flavor, taste, temperature of the market. And as you know, Michael Becker, I always forget, is it 14, is it 15,000 units that you guys over at SPI have purchased?
Yeah, it was somewhere around 13, 14,000 units. I lost count here recently. Need to go tally it back up. And then we've sold a bunch. So I think we're sold 4 deals this year,
Wow.
Paul. And then we have 1, 2 on the market that I think at least one of them will probably go. So I think we're a little under 7,000 units today. I think we're 6,700, and we got one in escrow to buy. So it's kind of always in flux, that number. So need to go tally it up.
Well, we talked with Michael Becker because, as you know, Michael's a former banker with one of the largest banks in the United States. He was a commercial loan officer and transitioned over to apartment ownership a number of years ago with his group SPI here in the Dallas-Fort Worth area. And he's an operator of multifamily properties. We're a banker over at Old Capital. So we kind of talk a little bit about what's going on in the marketplace itself. I'll go back to my general theme. Is it time, Mike, to again go on a long extended vacation? How are you seeing multifamily these days?
Yeah, it might be. So it's kind of, I just wrote a long newsletter. We do these quarterly newsletters at my company, SPI Advisory. So if anyone is interested, you just go to our website, which is www.spiadvisory.com. You just kind of search around for the newsletter. You can sign up and just get on the distribution list. We do it quarterly. So kind of released it a little over a week ago as we record this podcast. And kind of the theme of my little article was kind of the tale of two cities, kind of the best of times is the worst of times.
Sure.
So we're still seeing a lot of really good things, Paul. I mean, we're seeing tremendous rent growth. I mean, historically high rent growth. Maybe we're slightly off of the peak of, say, third quarter of last year, 2021, but not really. I mean, we're pretty much right there on most of the assets. And then seeing tremendous, occupancy and seeing some really good things. And then we're seeing some headwinds of, property taxes. But even with that, we've only started working on Dallas County so far, but we've got quite a bit of success coming down materially off the initial notice so far in Dallas County. So we'll see where in, Hayes, Bear, Travis, Terrence, Denton. So we haven't gone through the other counties yet. So we'll see kind of how that goes when we start negotiating taxes. Insurance wasn't good, but that went up about, 13%, I think. Payroll pressures are coming. General, R&M's coming, just everything's costing more in the supply chains. And then, the big one is really the capital markets. It's, if you have a floating rate mortgage, obviously we're seeing and expect to continue to see rising interest rates on the short end of the curve. So it's going to impact your debt service, your interest expense. And then if you have a interest rate cap, they'll protect you to a certain point, and then but you can get an escrow to rebuy one. So I was just telling you, Paul, before we start recording, I just got another notice yesterday where we were escrowing $6,500 a month for our interest rate cap that comes up in about 18 months. And they just changed the escrow to $65,000 a month. So tenfold increase to the interest rate cap escrow. Hopefully by the time we have to buy in 18 months, it won't be that bad, but it's going to suck up another $60,000 almost in cash every month on this one asset alone. So if you guys haven't started seeing those notices, you're going to start seeing those notices. So we reforecasted all our deals a month or two ago, going through our budgets, kind of, putting the forward SOFR curve in, seeing where interest rate caps are, kind of anticipating what these rate cap costs are going to be, how woefully short are we escrowing. Let's adjust our kind of internal metrics with, the good rent growth, and then kind of see how that looks relative to our distributions. We cut a couple deals already, and I think already set our June distributions, but July, we're probably going to cut several of our deals distribution. So I want to get ahead of this. I want to make sure I'm hoarding some cash for these, uses of funds I know are coming. And if you own a bunch of properties and you're a sponsor, you probably should be doing something similar.
So you've been probably banging the table or just, pronouncing to your limited partners for the last number of months that distributions are going to be cut in the future. Is that right? Or is this going to be to them?
To a certain extent, telling everyone that we're, kind of looking at all these deals and reforecasting and reminding them we have floating rate debt on about half our portfolio is floating, half is fixed. So, the fixed stuff obviously isn't going to be as impacted.
Sure.
It was worse the last several years. And, a lot of the floating rate deals have, seen outsized distributions and, just kind of the way it is. Right. So, if they aren't aware, they're going to be aware here pretty soon, Paul. It's just kind of what it is. So we're seeing, you just need to get ahead of it. If you don't, and you're paying this money out today or over the next 6 months, and then you just wake up one day and realize, man, I've been over distributing. I need to go claw some of that money back. It's a hell of a lot harder to get it back than it is just kind of hold it, today.
So, last month in May, we did the Old Capital Speaker Series where we kind of pulled the Band-Aid off and we let people know that, that Old Capital, we are seeing some pullback in the market, not only valuations with interest rates rising, cap rates are expanding or going to expand, and that type of information is that, that is just theoretical information with interest rates rising. We haven't seen any deals that have closed. Probably I think we're going to start to see deals that close based on, a change of interest rate back in March going into April, because that was kind of where the deflection point is. And where Mike says it's a tale of two cities, I really say it's the good, the bad, and the ugly. And the good has been the interest rates have gone down for 35, 36 years. The bad really is the 10-year treasuries rising. And the ugly, and it's really ugly, is the SOFR. SOFR is the index that we use on the short term, similar to LIBOR, that's kind of gone away. But that SOFR has gone from 0.05, 0.05, almost zero, to 1%. And now it's going higher. And so, with interest rates going higher, that's going to have a direct impact. Debt service is going to have an impact on values and what you're going to pay for these properties. If it gets more expensive to own these properties, again, we buy these properties, hopefully for cash flow. I'm trying to make sure everybody understands is that you just don't buy these properties for appreciation after appreciation after appreciation, but you're supposed to buy these properties for cash flow. So we were talking about just general themes. Mike was out at a conference in Las Vegas last week, and then him and I went to the Vertical Street Ventures conference in Scottsdale. Thanks very much to the folks over at Vertical Street Ventures out in Scottsdale at their 250 person conference. I was up in Northern California with Boris and Tony Lynn and banging the table on that with a bunch of high-tech investors that invest in multifamily. I came back and then also did a lot of talking to 600 people at a group called Lifestyles Unlimited. And we've been out trying to pound the table, just giving people a chance to understand a little bit more about what's going on in the marketplace. So, Mike, you were down, you left Dallas, you went down to Austin and take a look at some properties. Give me just a flavor, whether it's Dallas or Austin or San Antonio or just the world itself. Are you seeing values still falling? Is it time to jump in? Where do you see right now in the market?
Yeah, I think it's still kind of a little bit of price discovery mode, but yeah, for sure. I think that you've seen some retracement in price, Paul. It's just math at a certain extent. If you can borrow money at 3.5%, 4%, or you got to borrow money at 6%, it's going to have a big differentiation in your free cash flow and your debt service. And lenders do, test on either debt yield or debt coverage ratio or both. And so if, the debt service is going up, then you can have less and less loan dollars to make sure you can cover your mortgage payment essentially. So that's kind of pulling back loan proceeds. So where 75, 80% on a debt fund bridge loan product was all the rage the last 18 months. A lot of those guys are on the sidelines or, out of business for the foreseeable future. And so then the banks are getting inundated because they still have some money and the agencies metrics have pulled back and they're really largely not players because they're in the 50 LTV range or maybe south of that in some cases here. So, it's just what's going to have to give is price, right? So you're seeing that. So, I mean, I think of that same newsletter, I think we're seeing, call it 5% to date. I've seen about 5% kind of retracement on the Class A, probably 10% retracement on the workforce that's well located and, good quality. And I think probably more than that if it's a lesser located deal or it's got physical issues, maybe 15-20%. And like kind of the South Dallas, East Fort Worth, to be, regional about Dallas here, those types of locations where, you and I have been beating the drum for years and been kind of boys that cried wolf seemingly for years about not buying in the hood. And
Sure.
Those are, we're starting to see kind of a disparity here where cap rates are kind of generally rising, but they're rising a lot slower on the better quality deals and they're rising a lot faster on the lesser located, lesser quality deals. And that's what, like the cap rates should not be the same on a Class A deal as a Class C deal like it has been for years now at this point. So I think we're seeing a kind of a reset to normal. So if you got a high leverage bridge loan on a deal in the hood that's kind of crappy, you're going to have a little more problems than if you had, a Freddie Mac loan on a high quality asset in a good part of town. So I think that's kind of what you're seeing. I see, it seems like we'll probably see a little bit more pain, but I think we're starting to kind of see opportunity, Paul. We really haven't bought anything all year. We really tried, and we're fortunate enough to not really be successful because we were trying to buy deals and it just couldn't make sense. We have one deal in escrow right now. It was about a pretty good price, I thought, started, and it was about 5% off of where we thought it was going to kind of land when we started. So we've seen that kind of 5% adjustment down in Austin this week, looking at a deal that probably be, if we get it, around 230 a door. And then the Whisper, I think, was pushing 300,000 a door when they started. Now that was peak euphoria coming out like late March, early April. I mean, that number was never reality, but they, Austin was such on fire. If you go listen, I think we probably timed the peak sentiment when our interview of Matt Pohl several months ago. So go re-listen to that about him talking about how the market wasn't trading on historical fundamental metrics. And then boy, now it's reversed real quick. So I think it's starting to get to the point where we're dipping the toe in and seeing some pretty decent opportunities here. And, I think you just got to underwrite off of kind of what today's metrics are. So I think you basically need to size to a 7 debt yield, and that's kind of what your loans, 7.5 kind of going in debt yield. And I think that was
higher than that, to be honest with you.
Yeah, probably workforce housing higher, right? So Class A is probably 7 debt yield, and workforce might be what, 8?
Yeah, 8 to 8.5.
Yeah, and what was that like in January? 4.5?
Well,
5 walking in, pro forma 7.
Yeah, walking in about 4.5, and then now it's about 6. Walking into the deal. And a debt yield, again, is NOI divided by the loan amount itself. And so
we'll talk through that, Paul. Like, so what was that in January? What was today? Kind of go through that. I think that's important because you'll see the erosion of your loan proceeds by doing this calculation.
So we did about 85% of the business that we've done, and not just Old Capital, but across the United States. Debt funds, these non-recourse debt funds, have done a tremendous amount of business in the last, say, 2-3 years. These loans are funded through warehouse lines that they establish, and then the warehouse lines have to be paid off, and they do it through a securitization in the CLO market, the collateralized loan obligation market, and they bring into a pool. Well, it is a bunch of so just like if you are buying an apartment building, you need investors to bring their money to the table so you can fund your loan. And then the CLO market has to do the same thing. They have to bring a bunch of investors to fund the loan after the loan has closed. And so a warehouse line is the kind of the bridge to the CLO. And then that piece of that loan that you did is sold to pension funds, fixed rate funds. It's sold into the marketplace itself. Well, right now, it's been getting a lot more conservative in that marketplace. They're worried about interest rates rising and some of these pro formas not being able to be met that people did, say, 18 months ago. So sometimes I don't have maybe the best map that was created 18 months ago to what the market is like today, because everybody was projecting that interest rates were going to be staying the same at 3.5%, maybe 4%. But now when there's a spike or a black swan event, that interest rates now are fully baked in at maybe 5.5, and going up to 7%. That makes it real hazy. And so the ultimate investors, which is the CLO investors, are pushing back, and they don't want to do that 80% anymore. They don't want to do 75. They don't want to do 70. They will probably take 65, but they're trying to push you down to 60%, just because these loans are only for 3 years. So it gives you enough time to acquire the property, rehab the property, stabilize the asset, and be in a position whether to sell it at the end of the third year or refinance it at the end of the third year. But if you don't, these debt funds will put 1 year in, or maybe 2 years of additional time, but then you have to go out and buy another rate cap because these loans are adjustable rates. That loan goes from interest only to fully amortizing principal interest. And then if you don't meet those debt funds hurdles, that trying to get the occupancy up or trying to get the rents up to be able to refinance it or sell the property in the future so it can be paid off, then the debt funds put these hurdles in of debt yields that you have to hit while you're trying to get going to that maturity. And that is a problem, because one of the big sticks the debt funds have is a thing called a DACA account, or a kind of a lockbox account. And that's where they will take over the cash flow from the rents. So usually it would be, at the beginning that they establish an account in your name and theirs, but that account, if you don't keep with the parameters on what you should be doing, that they take that cash flow and they put it into their account, and they are responsible for the checks that go in, and then you have to kind of operate off the property with using the cash flow into somebody else's checking account. So that becomes a problem. So what Mike is referring to is, again, debt funds based on adjustable rates. And then we're looking at deals last year where it would probably be about 4.5 of a debt yield to go into it, with a 3.5% interest rate when trying to go 75 to 80% leverage. That was working because by the pro forma that you had given to us, that you felt that you could increase rents up, and that was kind of having that interest rate in static. So it was always going to be 3.5 to 4%. So those deals were working because they were giving us maybe a 7% debt yield out. So it kind of looked like you started at 4, you got 3 years out, you got at 7. And that would make sense today, because it's a little bit, they're becoming a lot more conservative because interest rates are rising. You're seeing 5.25, 6 on the entrance. So you have to have a minimum NOI based on the seller's collection of rents and expenses, and a step up of your property taxes or insurance, or however you're going to run the payroll. And then you have to be out at 8.25, 8.5 on year 3. So that's becoming a lot more conservative, because it's kind of like a teeter-totter. That those debt yields go up, your loan proceeds get cut. So that's what's happening, is that we're seeing lower loan dollars from just 18 months ago, from 6 months ago, from 6 weeks ago. Those loan dollars are cut. So you have to be, as an operator, have to have more money to come in and put money into these deals if you're going to buy it. So you talked a little bit, Mike, about how much you saw for leverage. Give me an example on one of the deals you're working on right now. What's your leverage point on that Class A building?
I think we got a pretty good deal on the purchase price, and so we're able to size all the way up to 58.
58% leverage. So
took a struggle to get to 58, and
42% down.
Yeah. So 42% down, and most of these other deals are sizes and closer to 50 to 55.
Yeah.
And they're looking at a lot of life co, because the agencies are just out for the most part, even though I think that you're starting to hear rumblings about Fannie and Freddie trying to step up and get back in, because they're woefully behind on their mandate this year. There's no way they're going to hit their caps. Obviously, no way with the market kind of slowing down. So I think those will be a little more interesting when you kind of get into the latter part of this year. But with the 10-year treasury going up, that doesn't help. That doesn't help their fixed rate equivalent sizing. Yeah. But anyways, so yeah. So we're sizing a 7 going in 7 debt yield.
Wow.
That's kind of what a lot of the life goes want to be, right? So I think that's what we're seeing on this nice stuff, because they want to walk in 7 debt yield on some of this stuff. And obviously the difference will be the spread on a debt fund bridge loan is what, 4 now?
Mm-hmm.
And 410, it was
425.
So that's 4.25% over SOFR. where back in January it was what, 275 to 325 probably.
Correct. Yeah.
Yeah,
gone
so it's
up.
gone up 100 basis points to 150 basis points. So we're solving life co money would have been 165 to 180 basis points
Yep.
spread. Now it's 2 to 225.
Yep.
So, it's half the spread. And to get that, you got to have better coverage. So they're sizing 7 debt yields.
Yeah, amazing. And again, people will ask, well, why doesn't Fannie Mae and Freddie Mac step up? And the answer is that Fannie Mae and Freddie Mac are not pro forma. They're not future income guys. They don't look at kicking the can down the road 3 years from now. They're looking at it through the rear view mirror as how income is today, yesterday, 6 months ago, 12 months ago. And they don't want to overemphasize where rents are going to go in the future. They want to see where they are right now. Because of that, the NOI versus really the values of these properties, it's really been only the bridge loans have been able to get to the higher leverage. But with the bridge loans, you come with you get clawed into buying an interest rate cap because the loan is based on adjustable rate. You get clawed into these debt yields, and you get clawed into these short-term loans. So they're only good for like 3 years with 2 1-year extensions, if you can get those 2 1-year extensions. So, I mean, you talked a little bit about, discovery of pricing. I mean, are the brokers buying into where these values are? Are the sellers? I mean, you guys are buyers and sellers. But typically, are you seeing the sellers starting to step up and saying, I better go now, because if I don't go now, if I'm looking to sell, I mean, it may not happen.
Yeah, I think you're starting to see that it's certainly coming. Expectations are coming down where 6 weeks ago they were not, right? Today they are.
Yeah.
So I think the brokers obviously know what's going on. I think for the first month they were trying to kind of be the confidence man, trying to talk their book and hold it together with the tape and chewing gum. And then the reality of the market that has moved, and people walk earnest money, and it's better to set some money on fire versus sticking with the bad economics on the deal. So you saw a couple of those deals either get retraded or attempted to be retraded. And then the new deals that kind of are hitting the market, I think the price, the brokers will tell you something along the lines of like, well, when we sized it or valued it, we were here. And then now we knocked 10% off of that. And now we're going to market here, So we already did a price adjustment, Mr. Buyer Pool, right? That's kind of what the talking points are now today.
Sure.
So I think they're starting to get real. And, we had a deal that we were going to go out with. I signed a listing agreement, and then I was told the broker to kind of soft market it. And it was this was, I don't know, early April, maybe mid-April. And kind of went to the top handful of buyers, and they were off the kind of the guidance. And we still have 8 years left on our mortgage and a bunch of money in the bank and a high quality deal in a high quality location. So we decided to just put it on the shelf, let's not, we don't need to sell. So why go into this teeth? We need to see some stabilization. So that's what would be my advice. So if you don't need to sell, I would not be selling, right? And I think you'll see some people that maybe are forced to sell, and that'll be some capitulation. I think that's going to be more in the workforce housing. And I've said that for years, and I've been wrong, and just kept, going against us. This might be the time where the workforce housing, cap rates expand, and, we might go back in time. I was talking with one of our broker friends. I won't name them or name the deal, but has a deal. I think it's like 1969 vintage. That one of the assets I used to own was right next door to it. So I know the asset pretty well. And they were thinking they were going to get, kind of a 5 cap on it because it's an all bills paid chiller deal, and pretty decent part of town, right? And the deal just, couldn't get done. There's very limited interest, and older, all bills, chiller system. The demographics pretty low from an income standpoint. So those are the deals are falling. So he's like, I think at the price the seller would take, it would be like a 6 cap. And I hadn't heard a 6 cap in years, right? Tax adjusted 6 cap, and no one's biting off on it, right? So it might have to get to be a 7 cap before they can sell it, or 6.5. I mean, that's kind of the price discovery where they thought they were getting above market cap at 5. It's really, they're at 6, and they don't have a deal cut yet. So it's probably not going to be a 6 cap. It's probably going to be something higher if they actually want to trade. And, the deal is performing well right now. But I mean, obviously, if you hit a big recession, you worry about the ability of that demographic to be able to keep the rent up because they're getting, smoked every time they turn around with, food and energy and, everything that impacts that demographic a little bit more than it does a nicer demographic. And that's why there's historically been a spread in the cap rates that have gone away the last handful of years. So, if you bought some of those deals, those are the deals that are going to have a little bit more problems.
Yeah, we're recording this in the middle of June, and CPI has just been announced, and the inflation's on fire. What's your 2 cents? I mean, we think that rents are just going to continue to trend up or stay flat. I mean, any advice about buying apartments right now? Just be careful. What type of debt? I mean, you're not. Are you doing a long-term fixed rate stuff, or what are you looking at these days?
Yeah, it's confusing. I mean, I've got the battle scars of 10 to the tunes of tens and tens of millions from yield maintenance and defeasance, prepay penalties. So I'd be a little cautious of fixing, 10, 12-year mortgage right now. If you do a deal, maybe take a 5 or 7 year if you want to fix it. If it comes with a large prepay, if you get like a step down prepay, it's a different animal. So as quick as it goes up, I think when JP spoke at your speaker series several weeks back, he had a very interesting chart that was about kind of from the time from the first hike to the first cut, the average is 2.2 years. And I think the longest it's ever has been 3.2 years or something like that. So, it feels like this is going to go on forever and ever. But I mean, they're going to be cutting here if they make it into 2020, if they make it in 2024 without a rate cut, I'd personally be surprised. So it's painful right now, but they're going to reverse on you. And if you make some decisions where you're fixing a 10-year mortgage at 6% or something like that, and then rates go back to 2-3%, 3%, 4%, whatever they go back to, I mean, you're talking like a 30% prepay, maybe more on your mortgage, right? So it could be really painful. So, paying an extra 200 basis points to 2% for 2 or 3 years is a hell of a lot cheaper than paying a 30% prepay if you take a 10 or 12-year fixed rate mortgage. So just be careful. It's not a no-brainer just to fix if it comes with yield maintenance or defeasance. So just be cognizant of that. And that's the voice of experience telling you that. So I think we're still looking to float. Most of the lenders are making you buy caps. So, those are really expensive right now. So I'd rather just post some interest reserve. I think we're seeing prices kind of come down. I think we're going to see rents continue to grow. I think they'll grow. I think when they start to slow, it'll slow more in the workforce housing. That is logical to me. I've thought that before, and I've been wrong before. So take that with a grain of salt. I mean, the market's stayed a lot hotter in the workforce housing than I ever thought it would. So I think that's the one that's most susceptible to fall because obviously they have less income and they get more impacted by inflation. I think the Class A stuff would do a little bit better. Depends what pocket you're in. I mean, they're still building a bunch of apartments, so potentially gets oversupplied. Every market's a little different. Every sub-market's a little different. I mean, obviously, if you're in Austin, we like Austin, but Austin's got a lot of tech jobs. So if we start seeing a bunch of layoffs in the tech space, maybe that hurts it. I don't know. That could be something to consider. Where San Antonio, Dallas got a lot of tech jobs too. Maybe not the high paying ones like you see in San Jose, but it's a confusing, swirling headwind, tailwind environment right now, Paul. But I think we're still seeing great operations, great fundamentals. Mortgages are exceedingly less affordable by the day with these rates going up. It's going to drive more people in the rental pool. It's going to continue the kind of the tailwind of rent growth going up because the alternative is buy a house or be homeless, right? So I mean, they're going to need to rent shelter, and I think that's still pretty good. So I think you just need to, if you do it, have realistic expectations on what the debt's going to be. And it's certainly not 70% or greater. You're probably, if you take a workforce housing value add deal, you probably need to be underwriting 65%, maybe less. If you're buying a Class A deal, you probably need to be in the, kind of that 50 to 60 range would probably be likely where you need to be. And you need to, put the forward SOFR curve or, market expectations in your model. And you need to, see what the cap costs are going to, interest rate caps are going to be, make sure that's in your model, understand what the lender is going to require you to do, and as well as just have a bunch of cash on hand. So it's going to, dilute returns by having a conservative structure like that. So I think pricing is going to come in, but if they reverse course and they get some inflation under control, and they got to put us in a recession, it seems like, and they start cutting, rates start falling again. And I think some of these buys will look really, really good here in a matter of, 2-3 years. If you have a little bit of hopes and you're bold to go out and take advantage of this kind of the second half of 2022 into the kind of the first half of 2023, I think there's going to be some hell of good buys out there. So I think we're going to try to be defensive and conservative on what we own and opportunistic buying in the marketplace.
You were on a number of panels this last week or so that people were asking you questions. Any funny stories or bullet of knowledge to help some of these people that maybe are getting into the business, or just operationals of what? We talked a little bit about setting, making sure you have plenty of liquidity, lower leverage on these deals, making sure you have enough money for these rate caps in the future. But any words of wisdom, anything that you heard at some of your conferences that people were asking that you thought was maybe a good question?
Yeah, we're going to have one of the conferences spoke out. Charlie Young from Madero is at as well. So I heard his little presentation, and he's extremely bullish on multifamily in Texas, and he does Houston and Dallas. Basically, he doesn't really do the other markets. He's a 2-market guy of them. They've done 30,000+ units, I think, in his career. So he's a very well-respected, prolific, smart guy. So we're actually going to have him on the podcast here soon. I got him to agree to that. So that'll be coming out in the next week or so, I think, once we get it on the books and scheduled. But, he was just kind of telling he's got some good stories. He started doing in the 90s, started doing multifamily in the 90s and managing a bunch, and he did a bunch of tough things, but he's kind of selling his workforce. He's got a lot of the workforce in escrow that he's selling, and he's buying Class A. So, this is kind of a clue that he's getting out of the workforce housing. He's a little concerned. He'll tell you from his own mouth, but my impression of his stance was that he's concerned about the income of the demographic that's in the, class, the 60s, 70s, and 80s vintage deals, more the 60s and 70s in his opinion than the 80s. But that kind of true C-class product, he's just, those people just are going to have some affordability issues with their wages not rising the same rate of inflation. So they're going to be probably pronounced delinquency and harder to push rents and things like that. So that was a takeaway, Paul. And I'm going to have him on. So I think we'll have him, maybe we'll do a 2-part deal with him, or
sure,
have a really long one, because he'll kind of talk through that. I think kind of state of the market, his opinion. He's really bullish overall. And then, at the same time, he'll kind of do story time with Uncle Charlie or something, because he's got some pretty crazy stories about, he owned basically half of Woodhaven, which is one of the worst parts of all of Fort Worth, and cleaned it up and sold it off for a bunch of profit. So he's got some pretty darn crazy stories about things they had to do to clean up Woodhaven years ago.
Yeah, he bought a concentration in a kind of rough, demographically challenged area of Fort Worth, and he did a great job. He was the new sheriff in town and carried a big stick and bought, not like 1 or 2 properties, but bought like 30 properties. And so he'll tell you stories about that will turn your hair white on some of the stuff that he had to do to kind of chase the bad actors away. Any tribal knowledge from some of the brokers out there? You, as I said, you went down to Austin. You're in contact always with the brokers in San Antonio or even Dallas and Fort Worth. Anything that they're saying? How's their inventory? Are they getting a bunch of stuff coming in? When do we think that we'll start to see this price affection of?
It seems like Austin's inventory is pretty thin right now, generally speaking. San Antonio as well has a little bit more than Austin, and then Dallas has more than both. And I just see the blast. I don't really focus on it, but Houston seems to have a lot out right now. Those are kind of your 4 Texas major markets. Seems to be that, maybe a little more workforce housing out. So maybe it's kind of people trying to get out of the theater first. So I think you're seeing a little bit of that. So I think we're going to see some, price erosion on the workforce housing. And I think a lot of the people in Class A, obviously we've seen some price erosion there as well. But I think, a lot of the groups are going to make similar decisions that I did. Hey, I don't have to get out of this deal. So let me just wait for a better moment in time. I don't have the capital pressures of, a bunch of deferred maintenance and sewers and things like that going out on a regular basis. So it's a little less capital intensive to own these nicer deals. So I think you're going to see less inventory there. So I think it's going to be a pretty quiet summer, to be honest with you, Paul. I think a lot of people, not so much here in Texas, but across the country, really lost 2 summers of vacation and travel. And I think that's what you're seeing with the airline tickets. There's, record demand and, people trying to go all over and get the hell out of their house for, a couple weeks in the summer. So I'm sure Europe and Hawaii will be jam packed full. I'm doing Hawaii. I'm sure a lot of other people are doing Europe. And so that's, I think we'll see a little slowing here as we kind of get towards the 4th of July. So I think July will be pretty quiet. And then the next big logical time for people to launch is kind of like right around Labor Day. So I think maybe we'll see a lot more rush of inventory hitting the market in Labor Day. I certainly wouldn't be pressing super hard to get anything on the market over the summer if I didn't have to. I think it would make more sense to kind of wait until you kind of see the next two Fed meetings and the hike in June, the hike in July, and kind of what the expectations are kind of going forward into the fall. I think with the CPI print and that we just saw kind of recently here, being I think it was 8.6, I think was a CPI print. I think you're going to see the Fed continue to beat the drum of hiking rates. So I think they'll be pretty aggressive on the front end of this, and then put us in a recession, and the stock market's going to dump. And then I think maybe they'll back off, and maybe we can see a CPI print not be so crazy if we get some of the supply chains open back up. It would be nice though if they would drill some oil in America. That'd be nice and open that up, but doesn't seem like that's on the table as of now.
Why drill it in the United States while you can drill it over in Saudi Arabia? Why not put a bunch of Americans to work? It doesn't. Yeah, that makes no sense to me.
Yeah.
But if you're telling me that you're giving me permission to take the summer off, I may do that. I may have to go on vacation.
Yeah, I think it's going to be a little slow here, but I think that's the to kind of put a positive spin as we wrap this up. I mean, that's your opportunity, right? I mean, I think part of me, frustrated and having to go through and make sure that we're watching our cash and cash flow and forecasting and reforecasting over and over again. But then on the other side of the coin is there's going to be some opportunity.
Sure.
And it's been hard to, make sense of a lot of these deals for a while. And I think, there's going to be a lot of opportunities. So those that have the chutzpah and, ability to put these deals together with conservative metrics, I think you're going to, see some of the weaker players get shaken out, and there's going to be some real opportunity to make a hell of a lot of money. So I think that is kind of the positive note to, leave you with. I think when I'm excited to get a couple of deals on the board because we're way behind what we wanted to do. I want to do 8 or 9 deals this year, and we got one in escrow that's going to be a 1031 exchange. So we haven't really done a large scale equity raise in a while. So I know a lot of my investors are probably frustrated with the lack of deal flow. And it's just us trying to be conservative and underwrite to things that make sense to us. And they just hadn't made sense for a while. And now I think we're going to start seeing some deals that make sense even with elevated interest rates. And then if interest rates do come down, these deals are going to be screamers. If we could buy it at a discount and then the rates get cut, I mean, we're going to make a fortune if we can do this right.
Well, tell me a little bit more about SPI. Let's finish it off on a high note. What does SPI in your group do?
Yeah, we're mainly focused on raising money and putting together high quality deals. I mean, that's essentially in the 3 of the 4 majors in Texas. And if you guys want to find out more information, we redid our website recently. So just go to spiadvisory.com. It's SPI like spy. Advisor.com. There's a bunch of information about us. There's a form you can fill out to get into our database or just to receive our quarterly newsletter, which we've been putting out. We hired a new marketing person about a year ago. So we really improved our game quite a bit from that perspective. And obviously been doing the podcast with you, Paul, for a long time. So you can go back and tell you how you should be careful and not pay the same cap rate on workforce housing 3, 4, 5 years ago. And then been wrong for 3, 4, 5 years. It kept going up. And now maybe is the moment I was a guy that was way early on this call, but maybe we're there. So I don't know if that makes me right if I was 3, 4 years early on it, but no. I guess it is what it is. But anyway, so I think our website's the best way to find out more information and reach out, make sure you get on our quarterly newsletter distribution. That takes a lot of time and effort. So we're pretty proud of what we put out. Yeah,
your newsletter is chock full of information about what you guys are doing. I mean, I'm surprised you put that much information out into the public, kind of giving a game plan or a map of what you guys have done or are going to do. And, that's I give you a lot of credit for being proactive and kind of sharing that information with everybody in the SPI database. So good for you. Again, Michael Becker, thank you. Smartest guy in the room. We certainly do appreciate telling us a little bit more about these fascinating times that we are living through in the multifamily world. I mean, it is truly a niche of what we do. So we appreciate you telling us a little bit more about